this video, we're breaking down the different ways to measure investment returns. We'll focus on simple return, time-weighted return, and money-weighted return. By the end of this video, you should better understand how to appropriately measure your investment performance. Before we get into it, here are the key takeaways from this video. Number 1, the simple rate of return is used to measure the profit or loss of an investment over time. It does not take into account any cash flows in or out of the investment. We'll talk about why this might not be the best way to measure your performance in an investment. Number 2, the time-weighted return helps eliminate the impact that the timing of your deposits and withdrawals can have on your returns. It's really a true reflection of how your money was managed. Number 3, the money-weighted return calculates the performance of an investment that accounts for the size and timing of deposits and withdrawals. Number 4, the money-weighted return is equivalent to the internal rate of return. All right, let's first start with the simple return, rate of return. The simple return is what you have today compared to what you put in as your original investment. It is the net gain or loss of an investment over a specified time period, typically shown as a percentage of the investment's initial cost. When calculating the simple rate of return, you are determining the percentage change from the beginning of the period until the end. In effect, this does not take into account the timing of your investments into the account. What if you started with $500 10 years ago and then added $100,000 a week ago? It's not a very appropriate way of evaluating an investment manager's performance. More on this in a little bit. We'll show the formula to calculate the rate of return on the screen. Now let's talk about a simple return example. The rate of return calculations for stocks and bonds is slightly different. Assuming an investor buys a stock for $60 a share, owns the stock for 5 years, and then earns a total amount of $10 in dividends. If the investor then sells the stock for $80, her per share gain is 80 minus 60 equals 20. In addition, she has earned $10 in dividend income for a total gain of $30. The rate of return for the stock is thus a $30 gain per share, divided by the $60 cost per share, or 50%. That's an example of simple return. YouTube is a great place to learn all the financial 101 lingo that we never learned in high school and college. I'm here to teach that. Hit subscribe and follow along. Now let's talk about time-weighted return. Time-weighted return compounds the daily returns of your account from the time that it was initially funded until the present day. It is most often used to evaluate the performance of an investment manager and compare them as well, because it does not consider when a client deposits or withdraws from their investment account. It is seen as a true reflection of how an investment manager managed your money and not a reflection of how your contributions and withdrawals affected that performance. The time-weighted return measure is also called the geometric mean return, which is a complicated way of stating that the returns for each sub-period, or let's say a daily return, are multiplied by each other. It's kind of a complex calculation. Now, what does time-weighted return tell you? It can be difficult to determine how much money was earned on a portfolio when there are multiple deposits and withdrawals made over time, which is common for most investment accounts. Investors can't simply just subtract the beginning balance from the ending balance, as the ending balance reflects both the rate of return on the investments and any deposits or withdrawals during the time invested. Deposits and withdrawals can distort the value of the return on the portfolio, sometimes severely if done right before large market swings. The time-weighted return breaks up the return on an investment portfolio into separate intervals based on whether money was added or withdrawn from the fund. The time-weighted return provides the rate of return for each sub-period or interval that had cash flow changes, deposits or withdrawals. And by isolating the returns that had these cash flow changes, the result is typically more accurate than simply taking the beginning balance and ending balance of the time invested in the fund, which would be simple return. The time-weighted return multiplies the returns for each sub-period or holding period, which then links them together, showing how the returns are compounded over time. When calculating the time-weighted return, it's assumed that all cash distributions are reinvested in the portfolio. The daily portfolio value must be calculated as each new sub-period starts with any deposit or withdrawal. These periods are then geometrically linked to determine the time-weighted rate of return. Now, because investment managers don't typically have control over their investors' cash flows, the time-weighted rate of return is a popular performance measure as opposed to the internal rate of return, which is more sensitive to cash flow investments. Money-weighted return. Money-weighted return compounds your daily returns and then weights them according to the amount of money that was invested each day. Another way of saying this is that money-weighted return is the rate of return that will cause the net present value of your portfolio's cash flows, deposits and withdrawals, and terminal value to equal the value of your initial investment. It's kind of complicated. It is analogous to a fixed rate on a daily interest savings account. And while time-weighted return compounds your account's unique pattern of daily returns, money-weighted return is calculated as the constant rate of return that would have been paid for you to obtain the account's ending value, given your account cash flows, deposits, and withdrawals. The annualized version of money-weighted return is known as the internal rate of return. Still following? Good. Money-weighted return is often a better measure of how you manage your contributions and withdrawals than how your investment manager performs. And because it transforms a varied set of daily returns into a fixed rate, it is super sensitive to when you deposit and withdraw cash. Money-weighted return compounds your daily returns and then weights them according to the amount of money that was invested each day. Another way of saying this is that money-weighted return is the rate of return that will cause the net present value of your portfolio's cash flows and terminal value to equal the value of your initial investment. All right, let's get into an example of time-weighted return versus money-weighted return on a simple level first. All right, let's say if you initially deposit $10,000 in your account and it doubles in 1 month, and then you deposit $100,000 and the market drops 25% in the following month. Your time-weighted return will be 50%, but your money-weighted return will be negative 31%. In this example, the investment manager invested well, but you timed the market poorly. All right, let's cover the difference between money-weighted rate of return and time-weighted rate of return. The money-weighted rate of return is often compared to the time-weighted rate of return, but the two calculations are super different. The time-weighted return is a measure of the compound rate of growth in a portfolio and is often used to compare the returns of investment managers because it eliminates the distorting effects on growth rates created by the inflows and outflows of money, basically the cash flow. It can be difficult to determine how much money was earned on a portfolio because deposits and withdrawals distort the value of the return in the portfolio. Investors cannot simply subtract the beginning balance after the initial deposit from the ending balance, since the ending balance reflects both the rate of return on the investment and any deposits or withdrawals during that time period. The time-weighted return breaks up the return on an investment portfolio into separate intervals based on whether money was added to or withdrawn from the fund. The money-weighted return takes into account that investor behavior from the impact of fund inflows and outflows on performance, but does not separate the intervals where cash flows occurred as time-weighted return does. Therefore, cash outflows or inflows can impact the money-weighted return much more. If there are no cash flows, then both methods should deliver the same or similar results. Now let's get into a more complex time-weighted versus money-weighted example. Let's imagine an investor made 3 trades in a particular investment over a period of 2 years. So let's assume that, number 1, on December 1st, 2020, the investor used $1,000 to buy 1,000 units of stock ABC at $1 per share. Number 2, on December 1st, 2021, they used $2,000 to buy another 1,000 units of stock ABC at a price of $2 per share. On December 1st, 2022, the price of stock ABC fell to $2.25, and the investors sold their entire holding of 2,000 stock ABC shares. In this scenario, the investor lost $500 in this portfolio over the 2 years. Here's how the return numbers for each of these performance methodologies differ in this instance. The money-weighted return would show a negative 12.77%. The time-weighted return would show a positive 11.80%. Despite the investor losing money on their portfolio, the time-weighted return shows a positive return. This is because the time-weighted return is only measuring the underlying performance of the shares held in the portfolio and not the actions of the investor buying into or out of these shares, the inflows and outflows, or the impact of the size of those actions over the period being measured. So as you can see, returns, they can get complicated. There's simple return, money-weighted return, and time-weighted return. Our suggestion is to mostly use time-weighted return, but it's also helpful to understand what your overall rate of return is in simple return, as well as understanding how your cash flows affected your returns through money-weighted return. I'm Tony from Wealthfront. If you need any clarification Ask me some questions below in the comments. Take care.